Hi there, Ridgely Goldsboro here from Harding Shymanski, and welcome to part 2 of our financial literacy series on best practices for credit and borrowing facilities. Be sure to also check out part 1 of the series on earning, spending, and budgeting. I'm here with John Key, HSC Senior Executive Consultant, to talk about credit and borrowing and how we can use these tools to our financial advantage. So John, let's dive in. How can we best use credit?
To use credit, you have to be smart about it. And that's a broad statement, but there are all kinds of credit that is available these days in our society today. You don't have to leave your computer. You don't have to go look for it. It's there. But you need to sit down and say, what do I want? What do I need? And how do I need it? If you're going to purchase a home, if you're going to purchase a car, if you're opening a credit card, all of those are different credit facilities. And all of them come with different pricing opportunities, risk opportunities, and cost. You have to be careful when you're selecting those.
Let me ask you, is it a good idea to use credit for long-term purchases? And if so, what or when?
Absolutely. Long-term credit, quite simply, and first of all, would be housing. Many of us, or most of us, will end up at some point in time securing a mortgage to buy a home, their first home, their second home, another home. That is long-term financing. Typically, a mortgage today is a 30-year commitment over a long period of time. Certainly, you can go, if your ability and your income allows, you can go shorter. You can go 20 years. You can go 15 years. But that is a very classic example of a long-term commitment. Another longer-term commitment would be buying a car. Many times buying an automobile comes with a term. You can get terms up to 10 years originally. I don't recommend that, but up to 5 years is reasonable because you want to ascertain the life of that equipment and be able to make sure that you don't have to go in and borrow money again against that vehicle while it still has debt, which would be a smart thing to do.
So then tell us, when is it best to use credit cards or credit lines to shore up cash flow shortfalls?
Credit cards, short-term lines, there is a place in your budgeting and your use and your handling of money for those. I have worked very diligently with clients in the past in my career of not depending on credit cards, not depending on short-term lines of credit to support ongoing expenses, because what happens in that case is you start leaning more into the short-term availability of those dollars, and all of a sudden you get upside down. You see more debt that you can pay off each and every month. My recommendation is that you use credit cards and lines of credit as a short-term instrument to be treated 3 months or less. And if you can take money out to support cash flow, do it over a 3-month period and retire that debt, that's the way to go. Keep in mind, if you go beyond 30 days on a credit card, you're going to be paying an astronomical amount of interest, because those interest rates, there'll be introductory interest rates, but those interest rates are going to be laden at about in the 12, 15, 18, 24% interest rate. Plus, you're going to have fees attached. And those are all embedded in your agreement when you take out a credit card. Line of credit, a little bit different. Those are usually 1-year instruments or less. The interest rates are a little bit less, usually provided by a bank or another financial intermediary, but they're still pretty much laid in with some pretty large fees to do that. My advice is that should be an emergency use and not something you use on a regular basis.
John, are there different fee structures based on certain borrowing facilities, and what are reasonable expectations about that?
Certainly, there are different fees to different loans. Let's start with mortgage. That is probably where there are the broadest array of fees. Many times you'll see online, particularly, a very attractive rate, and you'll look at it, and if you look at it closely, you may be buying that, what we call buying that rate down. And what that means is you're paying more points up front to secure that lower rate. I don't advise that when you look at that, or if you do that, make sure you calculate that it's still a great deal if you pay these large closing costs up front. That's pretty typical in mortgage lending. There are also other related fees in the mortgage area that you want to pay close attention to that they pass on. Certainly, you can get many of these online with a lot of the providers. I'm still a big fan of using your local financial partner, whether it's a bank, credit union, savings institution. You're going to know who you're dealing with on that side. It's very important. They can explain the fees. They can give you the options in person or over the phone or online with their online package. But you can get better opportunities to test those fees and things like that on those mortgage deals, get the answers. Secondly, the car loans. Those are very, very simple, typically 5 years or less. I don't recommend going longer than that. Typically folks roll their cars quicker than that. Those are smaller fees, maybe a few $100s or less, or processing fees on the front end of that. Many times you'll do that at the dealership and they'll run it through different banks to get the best rates that are available. Sometimes you can go directly to your bank. So you can do it either way, but there'll be a few $100 that'll be involved in those credit facilities, Ridgely.
Would you encourage us to do online applications for credit? And what are the pros and cons of that?
I have some opinions about that. And I like using the banks, people that you can go in and see, people you go in and talk to. I like that because of not because of the front end, on the front end side of it, on the back end. In other words, if you go in, you secure a mortgage and life happens and things may go sideways and you need to sit down and talk to your provider and say, hey, here's something that's happened. I need an extension. I need a restructuring. It's much easier to go in to see your bank, your credit union, your savings and loan, because they'll work with you on that opportunity to resolve those issues much easier, much quicker. There's not a lot of difference in price. You don't really gain a lot online versus working with your local financial partner.
Very important information. Thank you very much, John, for the great information. Stay tuned, everybody, for part 3 of our financial literacy series, where we will focus on savings and investing and the differences between the two. Very important topics for all of us. John Key, thank you so very much.
Thank you.